drill a little further down into consumer and what you're doing, because I mean, you mentioned that relatively speaking, earnings growth will still be the best here in this universe. But what would you buy? I mean, if I throw in, let's say, a stock like Maruti, look at the kind of absolute butchering that's happened in prices. So would you go in and buy maybe an iShares, maybe a Maruti, maybe even a Page? Is discretionary consumption at all on your radar?
So, keeping valuations aside, I think the key point to note out here, and I mean, let's talk about Page only because this is one stock which we own in the portfolio and it has given us 5,000% return from the day we bought, and this stock has never been cheap. So, it's all to do with length of the franchise, length of the growth, right? So, let's put some numbers again to Page. In 2008, this company made 24 crores profit. It had a P multiple of 22. Right? In 2018, this company made a profit of 324 crores and the P multiple is whatever, 60, 70, 80 times, right? So 2008 to 2018, the CAGR growth in earnings is something like 36%. The market cap CAGR is 42%. Let's for a moment assume that Page Industries growth is going to last from 2018 to 2028. I mean, I don't see any challenger to Page in current environment. I don't know about, and all the companies of the world are here in India, right? So that sort of a franchise to build what this guy has done, and the distribution will take a lot of time. But for a moment, let's assume the 70-80 P multiple goes back to 22, what it began with in 2008, right? If the company continues to grow its earnings, and there is no doubt in my mind at least that the company can achieve an earnings growth of 25 to 30. Even if the P multiple compresses, you still end up making something like a 15 to 20% returns going forward. So the moot point out here is that the quality of the franchise, it's not about the near-term earnings growth. It is how many years of growth can you see. And in my opinion, and this will be relevant for many other franchises, do you see challengers on the horizon for these sort of franchises? If the answer is a no, something like a Titan, something like a Page, etc., it's better off to sit through these corrections, both time correction and price correction, rather than take a call of flipping and then getting back in. It's easier said than done. It's not doable.
Fair point. Well, let's do one thing. Mr. Tulsian, we'll thank you on that note. It's 2:50, so let's just now start building up to the weekly options expiry as well. Sandeep Bagre is also with us with some trading ideas. Sandeep, good afternoon. What are your trades?
Afternoon, Anuj. I would go with a buy in a MRPL, stop loss of 72, target of 87, and a sell in a ACC, stop loss 1437, target 1386.
Okay, fair enough. Thanks a lot for those trading ideas. Manish, before we thank you, thoughts on IT ahead of TCS's earnings? That's been the hiding space, of course. Still, you think is the case?
And we are talking here relative performance, not absolute performance. By my belief in this sort of troubled times in markets is that the export themes, because of whatever is happening to the rupee, etc., and it's a function of oil prices, and 4th of November, God knows what will happen, etc. But given the earnings trajectory on most of the IT names, I would believe that the export themes, and that would include your pharma, your engineering, your graphite electrodes, all those names, you know, whoever has something to do with exports will relatively outperform in this sort of an environment. And so I would be inclined to tilt my portfolio holdings slightly towards export-oriented themes and taking some money off the table from the NBFC basket.
I heard you say Titan along with Page when you were discussing it. Does that mean you'll buy Titan at these levels? It's only gone one way off late, and that's down.
Yeah, so we are holders of Titan, so I have no problems in buying Titan.
Okay, but would you say this the same about Maruti? In the past you had it. I don't know if you still have it in portfolio, but it's fallen quite a bit now.
Yeah, so I don't have Maruti in my PMS portfolios, but I think, you know, Maruti again is a high quality franchise, and somewhere down the line it needs to be looked into when it comes to buying this stock for the portfolio. My sense is The next 2 quarters are going to be not so good for Maruti, and maybe the markets are pricing all of that in the stock price. It's to do with raw material costs going up. It's to do with exports growth not picking up. It's to do with the Shraddh season in India where volumes take a dip, and and so on and so forth. And valuations being what they were, and the entire market valuations are getting reset on the downside. But it's a high quality franchise. There's no doubt about it, and it would warrant a relook.
Okay, Manish, we leave it there. Thanks a lot for joining us today. The market's getting very volatile, by the way, just all over the place, really. There's been a bit of a recovery on the Nifty Bank, about 100 points from the low point as we build towards the weekly options expiry. Jonathan Scheissl of Ashburton now joins us on the show. Jonathan, hi, good afternoon. Big fall right now across the board. In fact, US fall was quite crunching, and the futures are indicating that perhaps we'll have a follow through. How do you look at the situation right now, given that the mother market is starting to fall now?
Yeah, so I guess the US was possibly the last man standing. Clearly, the debate is, everybody's focused on the US 10-year yield, broke through that crucial 3% mark. So I guess the question is, vexing equity investors is why did obviously that 10-year yield break above the 3% mark? Is it because of strong economic growth? And if that is the reason, then I think clearly that's still fairly, you can still paint a fairly optimistic picture for earnings, because obviously if growth remains strong. And so I guess that's what's vexing investors. If it is economic growth, then possibly this is a sort of buy the dip moment for those sort of markets. But if it's broader worries, then potentially, yeah, then obviously, some people are saying this is the start of a global bear market. So yeah, clearly worrisome times.
Is it, Jonathan? Is it that extreme? I mean, yes, US rates are a problem. People are really talking about it. But underlying US economy, I mean, is it really the start of a global bear?
Yeah, so the inflation print's going to be very important out there today. We are in an unusual time, which is fairly dollar bullish. You've got obviously fiscal policy on the one hand going in one direction, and then central bank policy going in the other. So tightening rates, loosening, with a fairly loose background in the US coming out of the Trump administration, is ultimately quite dollar bullish. So, and obviously the dollar has been very strong, but you can paint a fairly optimistic sort of scenario for the dollar. The issue today I think we face is, if you think since the global financial crisis, the key thing for investors to understand has been central bank behavior. I think that's shifting, and clearly the key thing for investors to try and understand is politicians, and yeah, that's the sort of issue we're dealing with.
Okay, so Jonathan, if that is the case, then how do you approach some of your India investments? And of course, the recent move has been downward in some of your biggest outperformers like Eicher Motors. But how would you look at these names now in this context?
So I think there's two things. I think firstly, if you look at it from dollar terms, clearly the market in India has got a lot cheaper. I mean, obviously you have to take a view on the currency, but obviously in dollar terms we've gone through a fair more pain than the domestic investors have gone through, just because of obviously the fall in the rupee. So I mean, for our perspective, we expect these bouts of volatility. It happens from time to time, but we are still optimistic on India from a medium to longer term perspective. Sure, there are uncertainties with crude oil. There's some political uncertainties that we're about to enter into a phase of uncertainty there as well domestically. But ultimately, India gets through these issues, and at the end of the day, one of the great things about investing in India is the type of franchises that you can find. Very well-run, quality companies with a structural story as well that you can add to them. So, ultimately, our investors, when we talk to them about India, we do try and persuade them they've got to be long-term investors, and we do try and tell them to expect the volatility. But of course, when it actually happens, it's another matter.
Well, one of those long-term structural themes is being questioned in India now, Jonathan, and that's the entire non-banking financial company model. Now, you did have HDFC in your China-India fund. I don't know if you still have the same sort of weightage and holding there. But what have you made of this entire issue around the credit markets here in India and the way NBFC's funding is sort of getting squeezed up and the measures taken? Would you still have a positive view on these companies?
Yeah, I mean, you guys will know better than me, but I think the death knell of the NBFC sector has been written many times before. The reality of the situation is NBFCs still have a very important part to play within the Indian economy. Obviously, banks, they play a function in areas of the market that banks simply don't have the bandwidth or the expertise to play in. I think the reality is, obviously, as we've been talking about recently, cost of capital is going up everywhere. Clearly, there's going to be a margin issue for NBFCs, and clearly, in the short term, probably the banks will pick up some market share if they want to. We still have a very large position in HDFC. I think companies like HDFC, the bigger boys on the street as such, what is going on today will give them some more competitive advantages over some of the smaller players. We have been concerned for a little bit of time about the LAP market and some of the lending that's been going on there. There were just too many players coming in. So I think a repricing of capital and ultimately a decrease in competition is probably quite good for the bigger players in the market. So we're still happy with HDFC. We'll ride through the volatility, and I think the franchise will come out stronger.
Okay, Jonathan, just hold on. The 3 p.m. move on the Nifty Bank is slightly on the upside. It's a bit of a short covering. So 24,700 has been protected. Let's, that's been the message. Now let's see if it goes any higher, about 24,800. But for now, 24,700 has been protected. The stock that's seeing quite a bit of action now is Castrol. Just pull out the intraday chart on Castrol. There's an announcement that they have tied up with Mahindra and Mahindra, and you're seeing quite a bit of buying. Of course, crude oil prices have also come down, so that's also helped. But Castrol India is a stock where you're seeing a bit of a buying activity right now. So, Jonathan, when you were in India last, you said that perhaps, China looks better than India in the near term. Given the recent moves, you still, keep that view that perhaps it's a good time to invest in China rather than India?
I mean, clearly we've still got political risk with the whole tariff regime, so that does provide uncertainty. But obviously, from a valuation perspective, when we last spoke, obviously India hadn't really started cracking yet. Obviously, subsequently to that conversation, India has come down a fair way. So the valuation discount is still large, but it wasn't as large as it was. I think as we probably approach, the decision on the tariff regime, potentially China could, there could be issues around the markets there. Obviously, we've got to watch to see what the government does, any more supportive measures to try and boost the economy. But the reality is that economy is slowing down. They're trying to control it in a calibrated, that slowdown in a calibrated manner. I think India has come off. It is looking a little bit more attractive. So probably potentially, we wouldn't be quite so bullish on China visiting India here.
So in that case, Jonathan, any new ideas that come to your mind, or maybe are you trying to add up more to your existing positions? For instance, a stock like Eicher Motors, which I believe you still hold, that's also come off quite a bit in this correction.
Yeah, I mean, that's been underperforming for, a couple of quarters, really. It's gone from obviously being one of the darlings of the sector, trading at a very high valuation, and clearly that valuation point has come down significantly. We still like the franchise. We still think there's good things going on within that company. So we're happy to hold that. I mean, new position-wise, we've been fairly inactive, but we have actually initiated a position in GAIL India a couple of days back into this recent sell-off that we've seen following the OMC's fall last week. For very company-specific news, we quite like GAIL, and we have been use the volatility to build a position.
All right, Jonathan, we'll leave it there for the day. Thanks a lot for joining us today. That's the view from Ashburton, raising this probability that this is perhaps start of a bit of a bear market globally. We'll take a break. Up next, we'll have the BTSG calls. Buy today, sell tomorrow from our technical experts.